The tension building within the silver market today is unlike anything we've seen in over a generation. The story isn't about hype or headlines, it's about math, physics, and a market system that has quietly drifted into imbalance. For years, global silver demand has been compounding across multiple sectors, while supply has stagnated or declined. The result is a structural deficit, chronic, widening, and increasingly unsustainable. What happens next will not just affect investors or miners, it could redefine how we value scarcity in an age of abundance. What makes silver unique is that it sits at the intersection of two worlds, the financial and the industrial. It behaves like money and a manufacturing input simultaneously. When both worlds start pulling in the same direction, you get a setup that is rarely seen in commodities. Industrial users are consuming record volumes, especially in photovoltaics, electric vehicles, and electronics, while investors, sensing inflation and volatility, are turning toward tangible assets again. These overlapping demands create pressure that no paper market or derivative structure can indefinitely suppress. On the supply side, the story is strikingly different. Global mine output peaked years ago and has shown minimal growth despite higher prices. Many of the world's largest silver mines are aging, grades are declining, and new discoveries are scarce. Silver is primarily a byproduct of mining other metals like lead, zinc, and copper. That means producers don't ramp up silver output just because the price rises. They respond to demand in the base metals they actually target. So, even as silver's demand profile strengthens, its supply remains tied to the health of other, often cyclical industries. The disconnect between where the world is heading technologically and how this metal is extracted economically is widening. Inventories tell the same story. Exchange warehouses have been steadily drawing down. London Bullion Market Association data shows silver holdings at their lowest level in over a decade, while COMEX inventories have followed a similar trajectory. Industrial consumers are already feeling the strain. Some refiners are struggling to secure consistent volumes, while certain manufacturers are reportedly extending lead times. This isn't a temporary bottleneck, it's the early phase of a structural imbalance. The global energy transition magnifies this dynamic. Solar panels alone could require more than 200 million ounces of silver per year by the end of the decade. As the world races toward net zero, the need for silver becomes almost non-negotiable. It's a critical conductor in every photovoltaic cell. No other metal matches its electrical and thermal properties at such efficiency and cost. Meanwhile, electric vehicles, 5G networks, and advanced electronics consume silver in ways that compound, not substitute. This is not demand that disappears when prices rise. It's embedded demand, driven by design, not speculation. The longer this imbalance persists, the more fragile the market becomes. The elasticity of silver's supply is close to zero in the short term. Even if prices doubled tomorrow, new projects would take years to bring online. Permitting, financing, and development cycles in mining are slow, especially in jurisdictions with increasing environmental scrutiny. At the same time, industrial consumers rarely have the flexibility to redesign around scarcity. When shortages bite, they pay whatever it takes. That's when prices stop reflecting incremental changes and start adjusting to structural realities. We've seen this before in other markets. When demand fundamentals shift faster than supply can respond, whether in semiconductors, lithium, or crude, the outcome is always the same, a repricing event. Silver's case may be more extreme because its dual identity attracts both industrial users and investors simultaneously. Once those two forces align under tightening supply, the feedback loop accelerates. Investors front, run scarcity, users secure inventory, traders close shorts, and the price mechanism becomes the only tool left to balance the system. At its core, this is not about predicting an exact number. It's about recognizing that the groundwork for a major move is being quietly laid in the data. The supply-demand equation is no longer cyclical, it's structural. Every ounce mined today is already spoken for by tomorrow's technology. while monetary uncertainty continues to amplify investor demand. That is the silent, compounding force that could drive the next great revaluation in silver's long, often underestimated history. Every major turning point in financial history begins not with a shock, but with a slow erosion of confidence. What we're witnessing now across global markets is that erosion unfolding in real time. Inflation is no longer transitory, it's structural. Growth is slowing while debt levels are accelerating. The old monetary tools, interest rate adjustments, liquidity injections, yield curve control are showing diminishing returns. And in these moments of systemic recalibration, capital begins to migrate toward real assets. Gold often leads that migration, but silver, with its dual character as both an industrial and monetary metal, becomes the asymmetric opportunity, undervalued, underowned, and underestimated. What's fascinating about this cycle is how macro forces are converging in a way that favors tangible value. We're seeing persistent fiscal deficits across developed economies, central banks leaning toward accommodation again, and currencies, particularly the dollar, showing fatigue after years of dominance. Historically, when real yields turn negative and purchasing power erodes, investors seek assets that store value outside the fiat system. Silver has historically thrived in those environments, often outperforming gold when monetary debasement meets real-world scarcity. The macro playbook is shifting. The era of cheap money produced asset inflation in equities and property. Now we're entering a phase where the excess liquidity finds its way into commodities and hard assets. As governments continue to monetize debt under the banner of stimulus or transition spending, the implicit value of paper assets weakens. Investors start to ask, what truly holds purchasing power in a world of engineered money? Silver answers that question uniquely. It bridges the old and the new. It's not only a hedge against inflation and currency debasement, but also a fundamental building block of the future economy powered by electrification and digitalization. Historically, silver's monetary function has always reemerged during times of uncertainty, when faith in institutions wavers, when geopolitical risks rise, when the global economy fractures into competing blocks. Capital seeks portability, neutrality, and tangibility. That's what drove silver's explosive runs in the 1970s and early 2010s. The conditions now are not identical, but the rhyme is unmistakable: excessive leverage, declining trust in fiat regimes, and the need for alternatives that can preserve wealth independent of political systems. The geopolitical backdrop adds another layer. Tensions between the major economies are driving a slow but unmistakable fragmentation of the global monetary order. Nations are diversifying reserves, accumulating gold, and increasingly discussing settlement systems outside the dollar framework. While silver isn't a reserve asset at the same scale as gold, its correlation to that narrative is undeniable. When the world hedges against dollar dominance, every precious metal benefits. Silver becomes the accessible proxy for monetary insurance, an asset that ordinary investors can still own physically without institutional gatekeeping. There's also the psychological element. Inflation erodes trust. When people see their savings lose value and their cost of living rise faster than wages, they instinctively search for anchors. That's why safe haven flows don't depend purely on data, they depend on sentiment. The perception of safety is what drives the early wave of repositioning, and then, as the data confirms the trend, it becomes self-reinforcing. Silver thrives in that middle ground. It's small enough to be volatile, but tangible enough to feel real. Its volatility isn't a flaw, it's a signal of its scarcity and optionality. The macro environment today mirrors an inflection point where policy fatigue meets technological acceleration. Central banks can manipulate liquidity, but they can't print trust. They can set interest rates, but they can't manufacture scarcity in metals that take years to extract. And they certainly can't suppress demand for critical materials embedded in the green and digital revolutions. Silver sits right at that intersection, a beneficiary of both distrust in monetary policy and confidence in technological progress. When viewed through this lens, silver is more than a commodity. It's a hedge against systemic uncertainty, a bridge between the old monetary order and the new energy economy. It moves not just with inflation data, but with belief. Belief in scarcity, in resilience, in the tangible value that paper promises can't replicate. That's why, as macro volatility intensifies and safe haven flows rise, silver's story becomes not a question of if capital will rediscover it, but when it will be impossible to ignore. The most underestimated force behind silver's long-term potential isn't speculation, it's technology. Beneath the headlines about inflation and market cycles, a far more transformative dynamic is unfolding. The world's shift toward electrification, decarbonization, and digitalization has quietly redefined silver from a traditional precious metal into a cornerstone of modern industry. It's no longer just a store of value, it's infrastructure. Every photovoltaic cell, every electric vehicle, every 5G antenna, and every emerging quantum chip carries within it an invisible dependency on this one element. The more advanced our technologies become, the more essential silver grows, and the less elastic its supply appears. Consider the scale of transformation happening in energy. Solar power has evolved from an environmental aspiration into an economic inevitability. The International Energy Agency projects that global solar capacity will triple by 2030, with installations surpassing 1 terawatt. What makes that significant is that each photovoltaic cell requires silver for its conductive properties, specifically for the efficient transport of electrons that convert sunlight into electricity. Silver's unmatched electrical and thermal conductivity make it irreplaceable at the microscopic level of performance required in solar technology. Even with ongoing research into substitution, no other material has achieved comparable efficiency. As a result, the solar industry alone is set to consume more than 250 million ounces of silver annually within the next few years, a volume that strains an already tight supply chain. But the energy transition doesn't stop with solar. Electric vehicles represent another structural demand engine. Each EV requires up to 50 grams of silver in its circuitry, battery management systems, sensors, and onboard electronics, roughly twice what a traditional internal combustion vehicle uses. As automakers race to electrify fleets, silver's demand curve rises exponentially, not linearly. By 2030, global EV sales are expected to exceed 60 million units per year. Multiply that by the silver intensity per vehicle, and the scale of industrial pull becomes staggering. This is not a speculative cycle, it's technological destiny. Beyond energy and mobility, the digital transformation deepens silver's industrial entrenchment. 5G networks rely on high-frequency antennas and low-loss connectors where silver's conductivity is indispensable. In data centers, silver-coated components help manage heat dissipation in high-performance computing. As AI models become larger and more energy-intensive, the hardware required to run them depends increasingly on efficient thermal and electrical systems. Again, silver is the quiet enabler. Even emerging technologies like quantum computing and next-generation semiconductors leverage silver for its stability and precision under extreme electrical conditions. In short, as the world digitizes and decentralizes, silver becomes the conductive thread tying every system together. The growth isn't just about volume, it's about irreversibility. Once an industry integrates silver into its design architecture, it doesn't simply pivot away because prices rise. Substitution is limited by physics. Copper and aluminum can replace silver only in applications where efficiency losses are tolerable, but in high-performance or high-energy systems, those losses are unacceptable. That's why silver's industrial demand is described as inelastic. It doesn't shrink when costs increase. This makes its price sensitivity unique. When scarcity emerges, demand doesn't fall off, it competes. We're entering a phase where industrial users and investors may find themselves in the same queue for limited supply. Mines can't scale production fast enough, and recycled silver accounts for less than 20% of annual usage. With inventories already declining, any incremental industrial demand forces a repricing event. What's especially compelling is that industrial growth doesn't require speculative mania. It's mathematically embedded in global decarbonization policies. Every government push for renewable energy or digital infrastructure inadvertently strengthens silver's floor price. This isn't just an industrial story, it's a macro evolution. The 20th century was built on steel, oil, and silicon. The 21st will be built on materials that enable efficiency, sustainability, and intelligence, and silver sits at the convergence of all three. Its demand is not driven by luxury or sentiment, but by necessity. Each innovation cycle amplifies its relevance. Each technological leap makes the metal harder to replace. And each decade of progress pulls it further out of the realm of mere commodity and closer to the core of global transformation. Silver's industrial trajectory isn't just growing, it's compounding quietly, inevitably, and exponentially. Every market narrative needs a dose of realism, not to dampen conviction, but to anchor it in probability. The idea of silver reaching $100 an ounce has captivated investors and futurists alike, but extraordinary outcomes require extraordinary conditions. To understand what it would take, we need to map timing against structure. The trajectory of silver isn't linear, and it never has been. It moves in long, quiet consolidations followed by explosive repricing events when multiple catalysts converge. The key lies not in predicting an exact date, but in recognizing when the macro, industrial, and psychological cycles align to make such a move plausible. Right now, silver sits at the intersection of two worlds, fundamentally tight yet sentimentally overlooked. Prices in the $40, $50 range reflect growing optimism, but not full conviction. Historically, silver doesn't rise on gentle trends, it revalues through inflection points. The 1970s, the early 2000s, and the post-2008 recovery all followed the same pattern: macro stress, policy distortion, and a sudden surge in liquidity. The market doesn't price silver higher because of incremental inflation data. It does so because faith in paper systems fractures, creating a flood of capital looking for tangible stores of value. From a probabilistic standpoint, several conditions must converge for silver to make a meaningful leap. First, sustained supply deficits. These are already here. The global market has recorded consecutive years of deficit, and inventories in major exchanges continue to draw down. Second, a macro trigger, a policy pivot or financial stress event that revives safe haven demand. Third, industrial inflection, a moment when silver's role in solar, EVs, and digital infrastructure moves from growth to necessity. And fourth, psychological capitulation, the point at which investors realize scarcity is not temporary but structural. Each of these on its own can support higher prices. Together, they could redefine the ceiling. Timing, however, is the hardest variable. Commodity cycles operate in slow motion until they don't. Silver's price can trade sideways for years, compressing volatility, then surge multiple times in a matter of months when the setup becomes too asymmetric to ignore. We're seeing early signs of this compression now. Industrial demand keeps expanding while mining investment lags. Inflation remains sticky, and central banks are inching toward easing. Historically, this is the incubation phase, the quiet before a sharp repricing. But the transition from build-up to breakout depends on perception catching up to fundamentals, and that process rarely follows a clock. It's also essential to understand that a $100 price doesn't appear in a vacuum. It reflects broader monetary and geopolitical shifts. For silver to hit those levels, gold likely needs to trade well above $300, The dollar must lose further purchasing power, and real yields would have to remain negative for an extended period. That combination implies not just inflation, but a reconfiguration of global capital flows. In that scenario, commodities as a whole would reprice, and silver, with its smaller market and higher beta, would likely outperform. So while $100 isn't a base case in the immediate term, it remains a rational endpoint under the right conditions, a high conviction tail event rather than a fantasy. In probabilistic terms, think of the path as an evolving distribution, not a straight line. The median forecast for silver over the next few years might cluster around $40, $60, reflecting ongoing deficits and moderate inflation. But the upper tail, the 10% probability zone, stretches toward $100 and beyond. That's where structural scarcity meets financial instability. It's not about predicting that scenario with certainty, it's about preparing for it. In asymmetric markets, the opportunity lies in being positioned before probability becomes consensus. Cycles of revaluation rarely announce themselves. They arrive disguised as complacency. The path to $100 silver won't be a parabolic sprint. It will be a sequence of stepped changes driven by tightening supply, accelerating industrialization, and moments of policy inflection. Each wave builds on the last until the market can no longer reconcile physical scarcity with paper pricing. When that point comes, it won't feel like a speculative rally. It will feel like an overdue correction in how we value a metal that the modern world cannot function without. Timing that shift precisely is impossible, but recognizing its inevitability is where conviction begins.